Good afternoon and welcome to BizTech Asian Midday Market Watch. I'm Samantha Voon, and let's start by taking a look at the market action today. Over in the US, we saw weak data from the US Purchasing Managers Index and labor market, and this intensified concerns about a slowdown in the world's largest economy. There is increasing worry that the potential September rate cut may be too late to prevent a hard landing. Additionally, poor earnings report from major companies like Intel and Amazon really overshadowed positive reports from Apple. The US stock index futures also fell sharply during Asian trading, with attention now shifting to the upcoming non-farming payrolls data for further economic insights. Over in Asia, stocks experienced significant declines, mirroring Wall Street's downturn. In China, markets over in China, markets recorded relatively smaller losses compared to their regional counterparts as they were already trading at their 5 month low. The Shanghai Composite Index fell 0.41%, as investor sentiments towards China remains weak due to the lack of significant stimulus measures from Beijing, as well as a series of weak PMI readings for July. Over in Hong Kong, the Hang Seng Index declined by 2.09%, mainly due to losses in major Chinese internet stocks. In Australia, the ASX Index dropped by 2.28%, and this caused by the mining stocks reflecting the substantial losses in commodity prices, as well as concerns over slowing growth in China. The futures for India Nifty 50 index indicated a weak opening, with the index expected to undergo significant profit taking after reaching its record highs above 25,000 points yesterday. In Singapore, the STI is down 1.01%, and in KL, the KLCI is down 0.75%. In Japan, the Japanese markets were the worst performers among the Asian peers, dropping by 4.85%, and the Japanese stocks had already experienced sharp losses yesterday after the BOJ took an unexpected hawkish stance during its end July meeting. The central bank raised interest rates by 15 basis points and indicated further rate hikes for the year, signaling an end to the stimulative policies that had supported Japanese markets over the past year. A surge in yen, driven by safe haven demand, and the BOJ's hawkish stance also negatively affected Japanese stocks, especially those with significant export exposures. Over in South Korea, the Kospi fell by 3.5% due to significant losses in major chip makers following disappointing earnings from Intel. So overall, Asian markets were broadly affected by fears of a global economic slowdown and mixed tech earnings from the US. So that's all I have for today's market updates. To give insights into markets, we have our guest today with us, Kelvin, Senior Market Analyst at Oanda in Singapore. Kelvin, welcome to the show again.
Hi, happy Friday, Samantha, and thank you for inviting me over as usual.
Happy Friday. All right, so we have, as we mentioned earlier, the US stock market had a sell-off, right? What happened there? Could you share with us?
Sure, precisely. So, on top of that, other than that, rather we call it highly value mega cap stocks. That's the culprit of dragging this underperformance of the Nasdaq 100 and the S&P 500 in the last 1 week or so, or even 2 weeks ago, because of their heavy weighted inside these two component key major US stock indices, is the fact that what Fed Chair Powell has mentioned in his press conference on Wednesday, because during Fed Chair Powell press conference on Wednesday, that means that comes after the FOMC meeting decision to actually hold rates unchanged at 5.25% to 5%. That's the Fed funds rate in US. He did mention about a concern about the situation in the US labor market that prompted him indirectly to actually give a kind of an indirect implied signal to kickstart a interest rate cut in September. So, and what's interesting over here is that yesterday's there was actually a report on not the official non-farm payroll data, but rather a kind of a survey-based ISM manufacturing PMI employment data that is one of the subcomponent of the ISM manufacturing PMI data, indicating to us that the manufacturing sector in the US is showing signs of labor market deceleration. That means, i.e., the confidence of the purchasers manager has been, we call it survey in this manufacturing PMI data inside the manufacturing sector of US has indicated that contraction in hiring, not the actual hiring, but intention to hire, I would say. So if you look at the figures, the number of this subcomponent of this ISM manufacturing PMI, they call it the ISM manufacturing employment subcomponent data within the PMI data actually slipped by a fair bit to 43.4 from 49.3 in the month of June. So that was the July figure. This deceleration is the lowest level since about 4 years ago. So it actually warrant the kind of a warning that the concern that the Fed Chair Powell that has mentioned in the press conference. So market participants view that perhaps it's now a bit late for the Fed to actually come in to actually prevent a labor market deceleration or labor market deterioration that could actually cause the US economy to slip into a recession. So initially, stocks price actually rallied on a soft landing, but this soft landing, we start to see this yield curve steepening. That means, i.e., the 2 year Treasury yield dropping faster than the 10-year Treasury yield, which if we are in a soft landing scenario, it should be beneficial to those laggard stocks like the Dow Jones Industrial Average and the Russell 2000, which has benefited in the month of July because the Russell 2000 rallied by 10%, the Dow Jones rallied by 4%, they actually outperformed the Nasdaq 100, which actually saw a drop about negative 2 to 3% on a monthly basis for July. But that fear of a hard landing has started to take shape after that rather, we call it deterioration, or a rather, we call it a sketchy report from the ISM manufacturing employment survey-based data that causes a fear to actually creep into last month top performer as well. Because even though if the US economy were to actually slip into a hard landing, regardless of a yield curve steepening, that could not actually escape the bearish momentum inflicted on the Russell and the Dow Jones Industrial Average as well.
So uh, yeah, what further implications does this have on the global markets moving
Sure.
forward?
So as we know that the US is still the number one important market, both in terms of global economic growth contribution, and as well as the tremendous amount of capital inflow that's flowing into the financial markets, especially given the fact that in the last 3 to 5 years, especially after COVID, that means we're talking about from 2020 onwards, the US stock market is still the top number one performer in terms of the 4 year rolling performance basis, especially heavily concentrated on the mega cap technology growth stocks that in the last 2 or 3 years has been kind of heavily valued due to this AI optimism template that has taken shape 2 years ago. So given this highly optimism that's been placed on this particular segment of the US stock market, if the US economy were to actually slip into a recession and the Fed starts to actually be more forceful in terms of their interest rate cut cycle, that means, i.e., they're being forced to kickstart a much more forceful interest rate cut cycle, that could actually imply more fear into the market. So we may start to see a undershoot of the bearish momentum. That's pretty much nature that how markets actually behave. If you look back in past steeper correction of the market, that could unfortunately spill over to the rest of the world, to a point that when market realized, hey, we've been undershot too much on the downside, to actually put away that it's more like a removal of optimism on the excess that has taken shape in the last 1 or 2 years or so. So we got to allow this behavior to wash out. But unfortunately, it will create a negative feedback loop towards the rest of the global markets as well, especially if the odds of this hard landing US starts to actually see a further uptick in the months ahead.
I see. Okay, so like since all eyes are on the non-farming payroll data, could you tell us what is your outlook on that?
Sure. Precisely. So, if you look at the situation right now, for the non-farm payroll data, there are actually two important components to watch out for. Firstly, is the headline number. That means the actual monthly jobs being added to the U.S. economy for the month of July. So this time around, market is looking at a very low number of 175K. So that is being kind of priced into the market of a rather softening trend in the U.S. hiring, actual hiring market space, right? So if this number starts to come down weaker than expected, let's say we're talking about 150K, for sure the odds of a hard landing has increased in US. And a number market participant will be looking out for will be this unemployment rate number, because this unemployment rate number in last month or 2 months ago is like to see a slight uptick to 4.1% to from 4%. So if this number starts to continue to tick up higher this time around in July to let's say 4.2%, it also actually increases the odd of a recessionary situation in US. And do not forget the fact that recession only been known officially when we see two consecutive GDP growth of contraction on a month-on-month basis. But however, if the other key economic data like the unemployment market, ISM numbers start to continue to show signs of deceleration, perhaps the US economy has already been in recession before the numbers starts to get officially announced. So that's why for sure market participants will be paying close attention to these two key matrices up from the non-farm payroll data going to report out later. So any number from the non-farm payroll data that is coming way below 175K, and as well as the unemployment rate ticking up further to above 4.1%, that could actually signal a potential hard landing scenario in the US economy, increases the odds, and that could actually potentially also see a further risk off in the global stock market as well.
Okay, thank you so much, Kelvin, for giving your valuable insights here.
Most welcome.
All right, this has been BizTech Asian Midday Market Watch. We had Kelvin Wong, Senior Market Analyst at Oanda in Singapore. Be sure to keep informed with the latest market updates weekdays at 1 p.m. I'm Samantha Voon, and this video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. It will also be on our syndication partners' TV stations, radio stations, and website. Remember to like and subscribe. Thanks for tuning in.